So I have this question here. I want to solve it, and question reads: the following are the summarized accounts of India, New, and Delhi for the year ended 30th June 2018, and you have the statement of financial position for India, you have for New, then you have for Delhi, then you also have what did I do? What did I do? You also have what did I do? You also have the income statement for the same India New. So this is for India. So this is the marker. So this is for India. This is for New. This is for Delhi. So this is the income statement for the three. Then you have additional information telling you that India has acquired 60,000 shares in New 3 years ago, and at the time of acquisition, the income surplus or the income accumulated profit is 15,000. At the date of acquisition, the fair value for New's non-current assets at the time had a remaining useful life of 10 years, exceeded their book value by 5,000. The good policy is to calculate goodwill arising or consolidation of a subsidiary gross with the NCI at fair value at acquisition. The fair value of the NCI of New was 34,000. Impairment review reveals that no impairment losses have arisen. India acquired 120,000 shares in Delhi 3 years ago when the accumulated profit was 5,000. At the date of acquisition, the fair value of Delhi's non-current assets at that time had a remaining useful life for 4 years, exceeded the book value by 20,000. The impairment review reveals the recoverable amounts of Delhi at their year-end to be 103,333, and you have to prepare the consolidated income statements and financial position for the Indian group. This is all what the question is about. Now, first of all, what we needed to do is to ask ourselves, why? How come this thing has gone off? First of all, let me check something. Okay, I think it's working now. I thought my network has disconnected. So let's go on. So first of all, what we needed to ask ourselves now is that how many shares is Delhi having, and how many shares is India New having? Now, from the financial statements, you can see from here that New is having 75,000 shares because every one share is 1 cedi. Delhi is having 40,000 shares because every one share is 1 cedi. So we must identify the number of shares being bought. So now when we come here, for example, India bought 60,000 shares. Out of the 75,000 shares from Delhi, from New, which gives you 80%. So this 80% or this 0.8 by 100 this by 100. So if you are buying 1,000 out of the 1,000 shares, it is going to give you 80%. India also bought 12,000 of the 40,000 shares in Delhi. So if I go and I say 12,000 divided by 40,000, I get 0.3. By 100, I get 30%. So by extension, what we are trying to say is that acquisition in new by India is 80%, and acquisition in Delhi by India is 30%. So therefore, the relationship between new and India is a parent-subsidiary relationship, and the relationship between Delhi and India is an associate relationship. And so therefore, here you can consolidate the accounts of new and India. If I may consolidate, you mean you can merge, add or merge the two accounts. Here, you cannot consolidate the two accounts. All you can do is to add the share of India, is to add India share in Delhi's account India accounts. So you are using what we call equity accounting. You are using what we call equity accounting. That's basically what we do over here. Now, the very first thing you need to look out for when there is an acquisition is to calculate your net assets, or to look out for your net assets. Whenever there is an acquisition, the very first thing you are supposed to look out for is your net assets. So you must know your net assets at acquisition, and you must also know your net assets at reporting. Now, when you go into the question, you can see that share capital for new is 75,000, for Delhi is 40,000. So I come here, put at acquisition, stated capital for new is 75,000. At reporting, stated capital for new is 75,000. I do the same thing for Delhi. Delhi stated capital is 40. I bring it there, and then I go my way. We're told that as at the time of acquisition, the income surplus on news accounts was 15,000, was said over here. And by the close of the year, news total accumulated surplus is 51,000. So at acquisition, surplus is 15. At the date of reporting, surplus is 51. I come here, I do same for Delhi. At the time Delhi is being acquired, its income surplus was 5,000. That's it here. It's at the date of reporting. Delhi's income surplus is 39,000. So I come here, at the date of acquisition is 5,000. At the date of reporting is 39,000. Now we are being told that at the date of acquisition, there has been some revaluation. And as a result of the revaluation, the net assets have increased in an amount by 5,000. So when I come here, I put in my 5,000 here at acquisition, and the same thing at reporting, because depreciation will be calculated at the end of the final year to see whether how much has been lost in value. Now we're being told that these assets, these 5,000 non-tangible assets, has a useful life of 10 years. So what it basically means is that if I divide my 5,000 by 10, I already have 500 for a year. 500 for a year, that's the depreciation, 500 for a year. Take note of this 500. Now, they said the acquisition happened 3 years ago. So what it means is that, let's say, this question, we are being told that it's for 2018. You know, we saw for 2018. So we are in 2018 now. This is where we are now. But the acquisition happened 3 years ago, 2017. 2015, 2016. So the acquisition happened 3 years ago. So the acquisition actually happened in 2015. But you are now in 2018 and they want to consolidate this particular account. Now, after the time the acquisition happened, they said every year you must charge 500. So it means that before the date of consolidation here, how much depreciation has been charged? Before 2018, we have charged depreciation of how much? 1,500. So at the date of reporting, my total depreciation charge so far is how much? 1,500. That is basically what they are talking about. I do same for Delhi. Delhi, they are telling you that the acquisition happened 3 years ago, and the net assets or the non-current asset exceeded their book value by 20,000, which have a useful life of 4 years. So I come here 20 divided by 4, meaning each year is 5,000. So before this year, they have charged how much? 15,000. So I divide my 15,000. I deduct my 15,000 from the total. And then this is going to be the balance I will be having in the books. These are the balances I'll be having in the books after I have totaled everything. The first step. Now, the next step is to do all calculations between India and Delhi to identify the appropriate share of profits and the appropriate share of loss from Delhi attributable to India. Now, take note. We said here that between India and Delhi, India has 30%. So whatever is on this account here, everything here, 30% belongs to India. And by extension, whatever profits Delhi makes in a year, 30% belongs to India. Now, they said something about impairments. We needed to calculate and know the impairments that has arisen as a result of the acquisition. They said that the impairment review reveals that no impairment loss have arisen. But you can't just say this one and you leave it over there. This is for new. Now, when you come to Delhi, the impairment review reveals the recoverable amount of Delhi at their year end to be this. Now, what are they telling you? They are telling you that at the end of the year, they have found out that the recoverable amount of Delhi is 103,000. What are they mean? Or what do they mean? Recoverable amount simply means that if you have to sell Delhi account right now, If you have to sell the business right now, how much are we going to get from that? Or if you have to sell the assets right now, how much, how much are we going to get? It's one of three. We compare it to the value of the business and see that, okay, if the value of the business or the value of the net asset is more than this, then it means that we've run out of lots. So simple as that. Now, when India was going to invest in Delhi, financial commitment has to be made. Investment in Delhi. This is how much India has invested in Delhi. So all things being equal, India has to make something out of it. The amount he has invested in Delhi. Now, after computing our net assets, we look out for what we call post-acquisition surplus. The post-acquisition surplus is simply the difference between the reporting date total minus the acquisition date total. So there's 74 minus 65 gives you the post-acquisition surplus of Delhi. This minus this gives you the post-acquisition surplus of new. So if you have invested 30,000 and they have run a business or they have run the business, and this was how much they have before you pay, and this is how much they had after you have come. Then it means after you have come in, there are 9,000 out of it. Within 9,000, all does not belong to you. 30% of this 9,000 belongs to you. So what it means is that you have invested 30,000. You have gained additional 2,700, making a total of 32,700. That is fantastic. But at the end of that same period, if they have to sell this business, they will get 103,000. In this 103,000 that they will sell, you will get 30%, and the 30% will be 31,000. What it means is that the business you are saying that your value in the business now is 32,700. In actual fact, it's 31,000. What does it mean? You have made a loss of 1,700. So for they has an impairment loss of for India. India has an impairment loss of 1,700 in Delhi's account. He will take it and take note of it. Now, when we are doing equity accounting, we calculate what we call investment in associates. The investment in associates is cost of investment plus impairments plus post-acquisition profit minus impairment loss. The post-acquisition profit here is 9,000. So 30% of the 9,000, I get 2,700, meaning that 30,000 plus 700, I get this one minus impairment loss 30,000. So actual fact, your value of investment in the associate now is 31,000, just like you have seen over here. Or this is another way of confirming the 31,000 over here. And they also said something about goodwill. They also said something about goodwill over here. Wait. So the goodwill, sorry. The group policy is to calculate the goodwill arising on the consolidation of a subsidiary growth with the NCR of fair value at acquisition fair value of this, blah, 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 blah. Now, they said something about goodwill. Now, if you know that the cost of investment is 93,000, so go back to the question. Cost of investment in new is 92,000. And fair value at acquisition. At the time of acquisition, News net asset has a fair value of how much? 24,000. So the total is 92,000. The fair value attributable to the parent is 24,000. So 92 plus 24. Then we are being told that at the end of the year, the profit you are making or the net asset at the end of the year, 95,000. Let's think of it. At the beginning of the acquisition period, your cost of investment is 92,000. Fair value is 24,000. But the net asset is 95,000. Look at it, 92 plus 24. You are saying that the value of the business is 116, or the value of the business is 116, or you more or less you are paying 116 for business, or this which is in actual fact how much the value of the business was. But in reality, the value is 95. So if you are committing 160 and the value is 95, then you are paying for something more than the value. And what you are paying for now is called goodwill. What you are paying for now is called goodwill. That is basic about it. So this is our goodwill, or this is how to calculate our goodwill on acquisition. Then you have your NCI, or your non-controlling interest. So you pick the fair value at acquisition and we calculate 20% of the post-acquisition surplus of new, and this one becomes the NCI at acquisition. I think I've made this particular one from here to here. So from here on, it is between India and new. From here on, it is between India and new. Then the next thing is to look out for is the accumulated profit for India. India's profit on the accounts is 114,000. There is an impairment loss of 1,700. Post-acquisition surplus 80% of the 34,500 here. 80% here, and then 30% here. So 80% there, 30% there gives you his share of the profit. So his accumulated income surplus for the year is 142,600. Then you have income from associates. So the associate made a profit of 26,000. That is Delhi. Delhi made a profit of 26,000 in the year, and there was a depreciation of 5,000. Take note, Delhi will be charging depreciation of 5,000 each year. So the depreciation to be charged 5,000 each year will come here. And so far as it is on equity accounting basis, it means that only 30% of that 5,000 will be charged Indians group. 30% of that 5,000 here. Now remember, India had an impairment loss of 1,700. So that impairment 1,700 will be fixed in here. So his total income from India is 4,600. Then we come here, subsidiary profit is 40,000. Yes, the profit is 40,000. So 20% of that 40,000. But this, we dealt with the 80%, we are now coming to deal with the 20%. So 20% of this and then 20% of the 500. Bear in mind, this year too, we will charge 500 here. So 20% goes to the NCR or the subsidiary. Then from there, I prepare my income statements and then I prepare my balance sheet. So my income statement, I add the revenue of India and then the revenue of new, yeah, operating cost of India, operating cost of new, and then take note, there is depreciation, depreciation of 500. I add it to it and subtract from it. I get my operating profit. Income from associates. We calculated the income from associates at 4,600. So you bring it over here. You get a profit before tax. You add the tax of India, tax of new, which is this one. Then you get profit for the year. Then you deduct the minority share from it. This is the minority share just calculated from it. You get what we call the group profit. Then from there, you come to the statement of financial position. The goodwill, take note, when you calculated the goodwill, you had 21,000 as the goodwill. So you bring the goodwill there. Then tangible assets, your 90,000 plus 80 plus the fair value depreciation 5,000 minus 1,500. You get this one. Then investment in associates. We calculated the investment in associates to be 31,000. Then you bring your current assets, you add the two, you get this one. Add all together, you get your total assets. You take out the liabilities from it, you get this. Then capital, you bring the capital of that of only the, what is it? Only India, capital of only India. So you bring capital of only India. Then accumulated profits, the one we just worked here, 142,000, this one. We bring that one there. Then non-controlling interest, 3,900, the one we just worked here, is a non-controlling interest. Then you add the 3, then get 348,000 as your total equity. So basically that is how you resolve this particular question. Thank you.